Morning, everyone. Thank you very much for dialing in. Today we're talking about private equity. Private equity can mean a number of different things, and we've got two trusts presenting today, who will be examining sort of different areas within the private market space. We've got Schroders Capital Global Innovation Trust, and this morning, and then this afternoon we've got NB Private Equity. Both of them target different parts of the private equity market, I suppose. There's a Bain global private equity report from this year that suggested that fewer than 15% of companies with revenues over $100 million are publicly listed around the world. And I think what that really illustrates is that there is a vast amount of opportunity for investors that are entirely outside of what publicly listed markets. So I think this is an interesting, well, it's always an interesting time to look at private equity given the size of the market, but with discounts having widened significantly for a number of reasons over the last year, this could be a doubly interesting time to look at the space. The format of today, or the presentation this morning, is Harry's going to give a brief 10-minute overview of the trust, and then we're going to hopefully have a conversation diving into some of the aspects of the trust. Obviously, in a usual scenario, we might have two different managers sitting next to each other, possibly even having a conversation with each other. Unfortunately, the time difference between the US and the UK means that's impossible. So we're going to have to, I'm going to have to pretend to take the other side of the conversation, as it were, and be a bit more engaged. However, if anyone who's listening would like to add a question to what we're discussing already, please do feel free to use the Q&A function bottom right hand side of your screen. I'm sure you're familiar with the format. I will try and incorporate questions asked into the conversation. So Harry, over to you. Thank you so much for participating.
Thanks, Billy, and good morning, everyone. So I'll start with just a brief presentation. I'm going to broadly cover a reminder on our strategy for the investment trust, an overview of the new portfolio that we've been building, taking a look at the market overall, and then go into some of the innovation themes we're looking at, and summarize the kind of current position of the trust. Hopefully the slides will be coming up in a moment. The first slide just talks to the experience that Schroders Capital, as the manager of the investment trust, has in the space of venture capital. We've been investing in venture capital for 25 years. It was the first program that was launched by Schroders Capital back in 1997, and really plays to the strength of the firm. The key thing being the fact that the team that we have has invested through various market cycles. They haven't been there for that full 25 years, but through global financial crisis, through the COVID-19 pandemic, and really we are a long-term investor in VC, and I'll talk a bit about why that's important. The trust itself, as people will know, focused on innovation, a global strategy now, having been predominantly a UK portfolio, and historically focused towards healthcare, but broadening those themes going forwards. So on the next slide, hopefully they've come up. Just a very high-level overview of what we look for in our portfolio companies. Four very basic categories here. Firstly, best-in-class products, services, and technologies. This is probably pretty obvious, but looking for businesses that are leaders in what they do, have high levels of differentiation, strong barriers to entry is important. Secondly, the companies are in high growth markets. These are markets that are underpinned by secular growth trends, so long-term trends that will play out over time, not short-term cyclical factors. Thirdly, that they are, people often forget that venture capital is really a people's business, so making sure that the companies that we come into are run by world leaders in their fields, and that we are well aligned with those management teams. And then lastly, this is a particularly key point, around investing alongside other high quality VC investors, the likes that can help with areas like recruitment, product development, marketing, etc. Areas where we as a firm may not be able to lean in, but those groups are very experienced in building very large businesses of the future. The next slide talks to the three different sub-strategies that we have within the fund. We have one specific strategy focused on the sector of life sciences. This is where we're looking at clinical or near clinical companies. They're exposed to mainly sort of technological risk because they're going through a series of clinical trials. This would be the highest end of the risk spectrum in terms of what we invest in, because the outcomes in certain instances can be fairly binary, but we're looking to back companies with the highest quality science and progress them through to commercial stage pharmaceutical assets. But that was intended to be a smaller part of the portfolio and have a very pronounced sort of reserving strategy so that we can follow those companies through to an ultimate exit. And then on the right-hand side of this page, the two cross-sector strategies that we have across venture and growth are really the two different stages of these early stage businesses that we target. The first being the venture companies that are typically quite early in development, may only have initial customers, are scaling up, investing in their products, developing their unit economic model, proving that out, and therefore exposed to a level of some level of product and technology risk, but mainly related to market level risk and establishing themselves within a given niche. And then the more established companies that we back are in the growth buckets. These are companies that have scaled revenues, established customers, will have a proven business model, maybe expanding into new geographies and to product extensions of the main platform, but are of a much lower risk profile. And the key here is really coming in at the correct valuation in advance of an exit that may be closer to reality than for the venture portfolio. And this is where we wouldn't need so much additional capital to reserve to follow on in those investments. The next slide gives an overview of the portfolio we've built since becoming manager of the portfolio back in December of 2019. We started making new investments from May of 2021. And based on those three buckets I just described, we've made 6 investments in our life sciences strategy. We've made 4 investments in our venture strategy, including 2 that have been announced in the last 2 weeks. And we've also had the exit of a company called Tession, which was our first investment in that bucket. And then lastly, 5 investments in our growth strategy. And the key things I highlight on this page reiterate what I was mentioning earlier, really about the fact that we're investing across secular themes in areas like fintech, marketplaces, cybersecurity. We're investing across the globe. So we did start investing in the UK, and then the remit was expanded globally. So our opportunity set is very broad. And we're coming in alongside very high quality co-investors where the companies are not reliant on us as a single source of funding, and where those investors are engaged day to day, helping the companies grow and build for the future. And the last thing I'll point out here is really the very pronounced strategy that we had to avoid investments over the 2022 period. We did invest in in a number of the life sciences opportunities where we had access to what we saw as very attractive opportunities. But given what I'll come on to describe about the venture markets, we took the conscious decision not to pursue very highly priced rounds in some of these companies, and therefore we didn't make investments over that period, but are now in the period where we will be looking to make further new investments. Moving into just a bit of an update in terms of the market on the next slide. This is an overview of global equity capital markets of deal sizes of more than 100 million. It gives an overview of basically capital that is being raised in public markets for different companies. The key things that we're looking at on this chart are really the IPO market, which can be a good indicator of the strength of global technology markets, and also I'll come on to talk about the follow-on market as well. But the key thing here being that there's been a pronounced decline since the start of 2022. But the important thing is you need to break this down by region, because the story can vary quite widely. So on the next slide, we break this down into Asia, EMEA, and the US. Asia has remained a relatively buoyant market from a public markets perspective. It has been subdued versus 2021, but is back to relative pre-pandemic levels. EMEA, particularly looking at IPO flows, has been buoyed by activity, particularly in the Middle East. So the numbers did decline at the start of 2022, as you'll see on the blue part of the chart in the middle. But those numbers are buoyed by IPOs in that one particular region. And then really the starkest place you see the decline in IPOs is in the US, where in Q1 of 2022, IPOs basically fell off a cliff and have been steadily growing back, which is encouraging to see. In addition to this chart, we've also seen the IPOs of companies like Arm, Birkenstock, and Klaviyo, which is an encouraging sign for the strength of the market going forwards. And one thing that our public equity team follows very closely in terms of a leading indicator for IPOs is also the size of those orange bars that indicate follow-on financing for public companies, which has been encouragingly strong, and it's good to see. On the next slide, just a brief overview of the different parts of the venture capital market and why we prefer to focus in on the earlier stage and less on the later stage pre-IPO rounds. On the left-hand side, you can see the significant growth over the 2017 to 2022 period in the growth in the pre-money median valuation of these companies. So at the seed and Series A stage, the valuations increased by just under 2 times. That's the kind of area that we would be liking to target between Series A and Series B. But the pre-IPO market was particularly impacted by a number of short-term entrants into the market that pushed valuations up by 7-fold over a relatively short period of time. And on the right side, this is clearly evident in the number of unicorn companies that created in a given quarter. That's the number of companies that are valued at more than $1 billion. Peaked in 2021 at 160 companies achieving that status in a given quarter. And that's fallen to 20 in the quarter, so 90% decline, back to pre-pandemic levels in Q1, Q2 of this year. So the key focus for us being on early stage, avoiding the pre-IPO hype, and really being an investor that comes into these companies earlier than others would typically, and then therefore benefiting from that multiple expansion in later rounds. The next few slides just talk about innovation themes. These are the 8 key themes that we're currently focused on. The bottom right 2 being those in our life sciences strategy, and the other 6 being across venture and growth. We're very excited about all these verticals, and the logos that are presented here are examples of companies that are in our portfolio either directly or on a look-through basis through our fund relationships. One area that we're particularly excited about and spending quite a bit of time on at the moment is artificial intelligence. So that is an area I'll cover in a bit more detail over the coming slides. The next slide, please. So artificial intelligence, obviously a very hyped area at the market at the moment. Every company that is out there is trying to position themselves as being in the center of this wave. We're being obviously very cautious, and having been investing over long periods of time, we try to see through the hype. One key reason that this area has been so hyped is basically the advent of generative AI, which is one singular part of artificial intelligence overall, which has been a sector that's been around for several years. The key reason being that ChatGPT, launched by OpenAI in November of 2022, reached 100 million users within 2 months, which is exceptionally fast when you compare that to other companies like, for example, Uber, that took 6 years to get to that level, or even the World Wide Web that took 7 years to get to 100 million users. So absolutely phenomenal growth, and it's amazing the pace of innovation that is coming from that part of the market. I'll actually skip over the next 2 slides and go to the slide that talks about our positioning in terms of trying to analyze and benefit from this wave in AI. So as a platform, Schroders is a large asset management firm. We have a significant number of relationships on the VC fund side. We are invested in a number of the top VC investors globally, a number of them that are investing along this theme, and we see the thesis that they are developing to target the AI wave. That's a key part of informing how we ourselves look at the space, and we have the ability to compare and contrast across different managers that may have contrasting views. And the other 2 areas to focus on are Schroders itself is a very big customer, and we have teams of dedicated IT professionals here that are specifically looking at AI and developing it for the firm, and that's very valuable insight that we get in terms of how the picks and shovels of developing AI tools are being embedded and used. And then lastly, the significant portfolio that we have across our fund relationships that are developing technologies along this theme. We have over 4,000 companies in our look-through portfolio, a number of which are shown there and are really playing on these themes and provide us with very valuable insights, both in terms of how they're developing, but also the ability to talk to the founders and see what's going on and get their sort of expert insights. I'll skip through the next slide. Just gives an overview of the fact that through our portfolio we have invested mainly indirectly, but in a number of the most highly valued AI startups. So we kind of have seen what has worked through those companies, which is always helpful. And then on the next slide, really how we go about targeting this theme. And it's obviously a very broad space, but we break it down into what's called the technology stack. So everything involved with being able to get an application off the ground. This starts from the bottom up in terms of looking at some of the key compute layers that are required in order to develop these tools. This is an area of the market where we are not very excited from an innovation perspective. There are very large established platforms that are developing the core hardware and cloud computing platforms that are very difficult to compete against. The foundational layer model, layer number 2 here, has been the hottest space in the last 12 months. As I said, with the advent of ChatGPT from OpenAI, we've seen a number of companies raising this space. It's very capital intensive, requires access to compute, which is key, and also access to key individuals. As a firm, we have made one investment in that space, but it remains a fast evolving sector. And then really the key areas that we think are probably most exciting in terms of future opportunities that potentially we can target from the trust will be in the infrastructure and application layer. We announced yesterday our first investment in a company that is an AI application software. We're quite excited about that deal. Unfortunately, we couldn't name the company because it's a very highly access restricted company, but we hope to be able to talk about that more in the future. But the real focus for us will be across the top layers of this tech stack and looking across a broad range of industries where these tools are being applied in very innovative ways that provide genuine utility to companies. So we'll be sifting through the number of applications that don't really provide benefit through to those that will have the longest value, and therefore will be the most sought after assets of the future. And then I'll skip through the next slide, broadly talked to, and then finally just conclude in terms of the fund overall. So this is a slide from our interim results in terms of the key areas that we're focusing for the fund, really supporting the companies as you'd expect. We have engaged in a buyback program where we are positioning the portfolio in order to be able to deliver that that buyback, leveraging proceeds from some of the older assets in the fund, and then aligned with what I've been talking about this morning, we are targeting new investments for the additional capital that we have available in some of these exciting areas like AI.
Fantastic, Harry. Thank you. And I'm sorry for missing one of the cues to move those slides on, but hopefully we might quickly go back to the slide that we missed, or I didn't show too much, which effectively is just the new portfolio starting to take shape there, which you might leave on just for the moment because any conversation you have might refer to any specific companies. So thank you. I mean, that's a great overview of the trust and where you are now. And it's exciting to see some, as you say, some news flow happening there in terms of new investments. But just zooming out again, you know, I guess my earlier statement was that, you know, private equity, you know, there's all sorts of different shades to private equity. Maybe you could just explain how the area of focus, you know, compared to, let's say, venture capital generally, and buyouts, buyouts being the area that NBPE, who are presenting later on this afternoon, focus on, and I guess what the difference is from an investor's perspective rather than or an investor into the trust would see.
Sure, absolutely. I think probably worth going to the one slide earlier than this one, which was the three buckets. So kind of leaving life sciences to one side. I mean, broadly, how we at Schroders Capital think about private equity, we bucket into venture growth and buyout. And there's probably 7 different parts to that overall spectrum. So within venture, there's even early stage seed venture, there's sort of Series B, mid-stage venture, and then growth can be conceived as late stage venture, or it could be conceived as more growth buyout, where they're typically more sort of bootstrap companies that are raising. But effectively, it's the evolution of a company through that cycle. So heavily loss-making but innovative companies at the venture stage, becoming more established and approaching profitable at the growth stage, and then in the buyout sphere, very much going into profitable companies, more moderated levels of growth. But that can then be, I mean, buyout can then be split into small, mid, late stage, turnaround, etc. There's various different tilts on the buyout side. But for us, we're really focused in on the sort of mid and late stage of the venture market, but not the pre-IPO part where we've seen a lot of capital coming in. So it's more early innovation, but not seed. So that's.
And I suppose the risks, as you outline here, you know, the risks, the earlier you go, the higher the risk, but not that I want to lead the horse to water, but presumably the higher the potential rewards.
Yeah, exactly. And I think it becomes really key to build a diversified portfolio, because you do have that level of embedded volatility. You know, companies that are exposed to tech product market risk, you can analyze how you think things will play out, but there's a whole range of different scenarios about the way things will work, and sometimes it just won't pay off. Some of them, the companies will fail, and we have to be able to have a diversified portfolio in order to be able to cater that. And then the winners have to be sufficiently large to go on and counterbalance the losers. That's very much the play in venture, and then more towards growth. There's more analysis you can do around certain factors. That means you don't necessarily expect total losses, but at the worst case, you know, you'd like to be recouping your capital, and then you'd like to have a few that really exceed the levels of growth expected, so that they drive the portfolio forwards.
Great. And I guess illiquidity is obviously a key part of, you know, that's by definition private markets. You know, maybe you could give us a bit of an overview on how you see the illiquidity and how that benefits you, but also what the quid pro quo of the cost, I suppose, is.
Yeah, so obviously these businesses are illiquid, early stage. I would say, I mean, there are key benefits at both the sort of company level and at the investor level, and they kind of align, but there are a few nuances. So Obviously, at the company level, if you're a founder of one of these businesses, you have far more control over your company in the private sphere. You're not subject to the extreme levels of market volatility. You can plan for the longer term. You don't have the regulatory burdens of being a public company, the quarterly reporting cycles that those companies are exposed to, and therefore build things that are much longer term thinking, and experiment in areas without being subject to too much scrutiny beyond the close-knit investor group that you have. The key thing from an investor perspective as a result of that is that we're far closer to those companies. So typically we're board observer on the companies that we invest in. We're very engaged with management, helping them in areas where we can, particularly around strategy, around fundraising, around how they think about equity capital markets, how they think about exit planning. We can have those detailed conversations with all the data that we'd ever need in order to be able to give our advice. And the companies that are in the public markets just can't have those conversations because it approaches material non-public information, favoring one investor over another. It's just there's too many conflicts between the relationships of being what is effectively quite a regulated industry. So we can add a lot more value. We can play around with things that will benefit those companies, and it's all typically with a view towards a trade sale exit. So about 85 to 90% of our portfolio exits the trade, which is not often talked about, and only 10% really goes through to an IPO, because the attractions of being a public company today are just not that great. So the focus is on building long-term companies that are attracted to these trade buyers that sell at good prices.
And how much, obviously you're investing as a sort of minority investor, but how much, let's say the team behind the company don't take your advice, or you think it's going a different way, or a different way to the way it should, how much, I guess, do you spend a lot of time talking to fellow shareholders? And obviously you don't want to be a concert party, but or maybe there isn't such thing in private markets, but how does that interaction work?
Yeah, I mean, you don't have the concept of a concert party. I mean, you do with certain companies that are certain PLC private companies that are subject to takeover panel rules, but that's very, very few. So you can talk to other shareholders. Typically, I mean, it's a key part of the DD that we do when we come in is talking to the management team, talking to the co-investors, making sure that we have a good level of alignment, looking at really sort of nuanced, detailed things like the cap table. What price did these investors come in prior rounds? Is that aligned with where we're coming in? If the company's bid for at a certain price, what are the incentives to sell or remain invested? Where does this fit within the fund, the evolution of the fund that is invested in that company? If they're in maybe year 10 or 11 of a 12-year fund, and we know they're going to have to sell in the next 2-3 years, we're not necessarily that aligned with that other shareholder. So there's so many different levels of analysis that we do, but the key is really ensuring that when we come in, we've all got the same buy-in to a business plan that gets us to an ultimate exit, and we're aligned in terms of how we think value will accrue. That can change, but at least on the entry point, we know there's that good level of alignment.
Sure, and obviously finding those investments or picking the right ones is one thing, but obviously access or finding those investments, because obviously on the stock market you just bring it up on your your platform or your trading screen and press go. Private markets, it's the complete opposite. Maybe you could talk a bit about how Schroders Capital finds its investments. That's in before you're obviously deciding which ones are good ones and which ones are ones you don't necessarily want to pursue.
Yeah, absolutely. So as I said, Schroders Capital's been investing in VC for 25 years. It started in basically venture capital fund of funds investing, and a key part of the program remains our investment in some of these VC funds. So partnering with those kind of groups and looking at what they're investing in through their portfolio companies is a good way for us to access businesses. It kind of varies in terms of what access we have around the world, depending on what relationships we have. I'd say that's definitely one part. There's the team we have that we've got specialists in healthcare that are out talking to healthcare companies all the time. We've got specialists in tech and consumer and other areas that are continually out talking and networking. We continue to get inbound referrals. That's typically of a lower quality normally. And one of the key things that we do is market mapping. So thinking about the stages of companies that we like, knowing that we are investing globally, looking at specific regions, specific themes, and mapping the companies within those themes that we then want to target. So for example, on the AI theme, mapping out across Europe, US, Asia, what are the companies that are aligned with that theme, and making sure that we are talking to all of those that are coming to within our size range, and then being able to position ourselves for a future financing round. And then on the other side, also the connections that we get through Schroders as a broader organization, as a buyer of tech products. You know, we get referrals from other people across the business about interesting things that they're looking at, and we can feed that into our sourcing.
And you were mentioning earlier, diversification is obviously a key part of, you know, the higher risk investing approach. How do you think about the sort of portfolio in terms of, do you have any predefined ideas of how much you want in any particular? I mean, we've got three up there in front of us, you know, life sciences, venture growth, which obviously within venture and growth, there's all sorts of different sectors there. But also geography, you know, is this, how are you thinking in terms of the top down, you know, obviously marrying the bottom up, picking individual companies?
Absolutely. So, I mean, it's a challenge with this portfolio, given we obviously have a relatively established portfolio there, which, as I said, was relatively UK, relatively healthcare focused. A lot in has historically been in the therapeutic space. And broadly, how we're thinking, so we've got a broad outline of 25% in public equities, which can be broadly diversified across companies that have gone through a listing. So we kind of sit that to one side. And then across these three different buckets, I mean, ideally, we're targeting about 10% in the life sciences strategy, so small, very diversified. Venture, again, about 20%, so small, very diversified. And then 45% in the growth bucket, which would be these more established companies that don't necessarily need to be so diversified, that have got a good growth trajectory. But it's kind of a moving target, because we're moving between the position we are today with the current portfolio, that kind of pro forma in mind, but you never expect to get there. So it's always about thinking about regional diversification, thinking about stage diversification, thinking about theme diversification, and being able to build up as opportunities come across our desk in that way, rather than thinking that we can get there overnight.
But in that sort of, you're not targeting specific amounts into, you know, emerging markets or US or whatever. It's more opportunity led, and making sure that, you know, if you're considering new investments, maybe you aren't getting too heavily into US AI companies, for instance. You know, is it that?
Yeah, exactly. Yeah.
And then the sort of non-Schroders portfolio. We just had a question come in here. What proportion of the portfolio predates Schroders? But I know that it's a bit more complicated than that, because obviously some of the companies that you picked up, you're sort of actively excited about and putting more money into, and others you're potentially actively managing yourselves out of. And you know, is there a sort of, can you give people who are listening just a quick overview of what the state of play is now, as it were? You know, I think rightly a lot of your presentation is focused on the future, which is where INOV, as it were, is going.
Absolutely. I think that we've got a slide on that in the appendix. So it's just after the portfolio slide.
Do you know what number that is? Or
24 on my presentation, but yes, that slide there, perfect. Exactly.
Look at that.
So
look at that.
Q2, we're at just over 20% of total investments in new investments. But then we had 30 million of cash at the end of Q2. So including the cash, we're at 30%, over 30% of the fund in cash and new investments in aggregate.
Great. That's very helpful. So, you know, I suppose there's been a bit of, I know it's a different area of, you know, well, maybe it's not. There's been a bit of, in the FT in particular, the bang on about valuations and the FCA looking into valuations, but maybe you could just explain how your companies are typically valued, and I guess in the absence of, as you've already said, IPOs are not necessarily the be all and end all in any way, but what are the near term growth drivers for the trust?
So actually, if you flick through a few more slides, there's a slide on our governance framework. So just touching on valuations. Yeah, that's the one there. If we go back one. Yeah. So a key thing to highlight is that the responsibility for valuations as part of the AIFM role was transitioned to Schroders in 2022. That was a key change that was made by the board. We have a fully independent valuation team that sits outside my team and outside the reporting lines that I have, and that has various levels of governance through Schroders Capital Private Equity, Schroders Capital at the private assets level, and then through into the Schroders Group as well. This chart just broadly outlines how the valuation inputs come from both our team, but also information from GPs and companies that we're invested in. So, for example, on a company like Revolut, we have access to certain amounts of information, but we also have significant fund investments through our other programs. And so we see the valuations of that holding through other managers as well. And so the valuation team have access to quite a wide range of information that can be factored into their valuation. And then they filter that up through their work with IHS as the independent outsourced valuation agent, into that internal team, and then up through the various committees as I described. In terms of methodologies, I think that was part of your question. You flick through 2 slides. We talk broadly here about the kind of valuation techniques that the valuation team prefer to apply across the 3 different strategy buckets. So within the life sciences segment, typically these are companies that are developing drugs through a defined clinical pathway. There'll be analysis done around the size of markets, the probability of success, that is basically a milestones-based analysis of how those companies might progress. And so as those companies produce efficacy data, safety data, etc., and progress on that journey, that they can be assessed against those milestones, and if positive can be revalued upwards, or if negative, revalued downwards. And then in the venture and growth buckets, the preference, and this aligns with the IPEV guidelines, which is the key guidelines followed for private equity valuations. The focus is on maximizing the use of observable inputs. The focus of the team being to use a market approach typically, so trying to align valuations to companies that are in the listing markets and how those companies are trading, and then particular nuances for companies that may be slightly different in certain areas, or have specific, for example, product launches or regional expansions, etc., that may not be absolutely guaranteed and defined within a growth trajectory, that can be factored in. And then another layer actually that's not captured on this slide that talks about, to the very level of detail, of what share class do we own in that company, and if you don't own the class of shares that's senior ranking, that those shares may be attributed a slightly lower value. So they go into quite a bit of detail, but the focus is really on trying to align our valuations with the broader market, and then also bring in factors like the prices that companies raise new rounds at, and making sure that that's clearly reflected in the valuations of the businesses.
And I guess markets everywhere have been pretty horrendous. And does that mean that sort of new opportunities are coming to you at interesting, or perhaps not uninteresting, valuations? But also maybe just looking forward, presumably valuation changes, as in price, a PE multiple or whatever, is actually not a big part of where you think the value is going to come from, or the value growth is going to come from, in that it's actually a company growing its earnings or becoming profitable and then growing significantly. That's the thing that really is going to be the swing factor. So you're not trying to buy companies on a, I mean, I know PE doesn't really apply to your area of the market, but equivalent, a PE of, you're not trying to buy a PE of 5 and then sell it on a 10. It's really, you buy it on a 5p, and maybe if it's 5p in the future, it doesn't matter because earnings have grown by 6-fold or something.
Yeah, so I mean, these, taking life sciences to one side, and the key with these companies is, I mean, firstly, yes, it is a very attractive environment to be investing. I think the comments generally are that flat rounds are the new up rounds in this environment, which is a nice time to be investing. And as I mentioned, a lot of those investors that came into those later stage rounds and pushed those up, that was slightly filtering through into the earlier stages, as we saw, they've retrenched. So the valuations are coming back to much more normalized levels, where actually for us as a long-term investor, we would like to be deploying as much as we can into this environment. We're not buying on PEs. I think that's clear. We will benchmark to as far down the P&L as we can. I mean, we are typically investing initially in loss-making companies, so it may be at the revenue, ARR, gross profit level, depending on the availability of data. But these companies are growing so exceptionally fast. So where we might be costing our capital at 20 to 30%, the companies themselves might be growing at 50, 60% plus. And within that remit, knowing that these companies aren't returning cash, you do still have some margin for the companies to have a contraction in multiple. So in some instances, you do have to pay up for that growth. But when you model through, and we typically build out a high base and low case for every investment that we do, that typically in those companies where we're maybe coming in at higher valuations, that we very much model the valuations normalizing to more market rate levels upon an eventual exit, so that we have credibility in what that exit outcome might be.
Sure. Thank you. We've only got a small amount of time left, but I think we've pretty much covered all the Q&A. I've got a couple of, one question on you mentioned sort of making some space for, or make some cash for buybacks. How does the board, I know it's not you who's doing the buyback, so you've obviously party to the board discussions, presumably. How do the board view buybacks? Obviously, at the current discount, it's massively accretive to continuing shareholders, but obviously, no one wants to see the trust grow so small that it's unviable. So, how are the board thinking at the moment?
Yep. So the board announced a new buyback program in the annual report, which was released in April of this year. The commitment was to buying back at least 5% of shares for this calendar year and for next calendar year, that's as a minimum. And then an additional commitment to return through buybacks 25% of any realization proceeds from assets that have been defined in the legacy portfolio, which was companies that were owned or held in the fund prior to Schroders taking on management. So if any of those companies are sold for cash proceeds, 25% of that will be going back into the buyback program, but a minimum of 5% of the share cap each year. And it's a real key focus. And I mean, having talked to shareholders, we ourselves talk to shareholders, and obviously the board talks to shareholders as well, that buybacks is very important. And therefore, within the way that we're managing the portfolio, it's a key priority. So we're constantly balancing the needs of that buyback with plans for new investments as we try and build out the diversification that I talked about across that new portfolio.
Great, thank you. And I guess to leave it, at the moment I feel certainly, markets have come back a long way. It's an uncertain outlook, but what would you say to summarize the sort of key risks and opportunities for shareholders in this trust? I
mean, we've got some amazing opportunities out there for new investments. I'd very much highlight that. I think within the existing portfolio, we've got some very strong companies, both on the new side and also on the older holdings. Likes of companies like Atom Bank that just recently raised 100 million round. These are great achievements, and they're propelling. Yes, the valuation implications are impactful in the short term, but the the capital that delivers to the company in order to help it scale to its next phase is really important. So, you know, we're really looking towards those companies to deliver on some of their milestones. I think we expect maybe the legacy holdings to be perhaps a bit more volatile. Maybe a few of them are more earlier stage than we would have otherwise liked. And so, you know, there may be developments in that side of the portfolio, but we are very, very high conviction on the new portfolio and what we're building there. And we'd really like the opportunity to invest more capital in some of the other interesting opportunities as we build out that part of the portfolio as well.
Fantastic, Harry. Thank you all for dialing in, and on your behalf, thank you. Thanks go to Harry for taking us through that, and I think very interesting. Do dial back in at this afternoon. I think it's at 2:30 or 3 o'clock. Sorry, 3 o'clock to see the other side of the fence, as it were, in the buyout space, NB Private Equity, and do send any follow-up questions you have for Harry to us, and we'll try and answer them. But thank you very much, Harry, for your time, and thank you all for dialing in.
Thanks very much.